radio for a really great future. We're talking real money.
All right. Here's the deal. I know we're in debt. United States we owe a lot of money. And we owe it to, I don't know who. We owe it to a lot of people. Well, we're going to talk about who we owe it to. But here's the thing. Are you worried that Mr. Potter is going to foreclose on the United States?
I didn't watch that over the holiday. Dang it, I missed that.
I did not watch it over the holidays this year either. I didn't. The only one I watched, the movie that I watched again this year was National Lampoon's Christmas Vacation.
I watched that too, and Elf. I think those are the only
I didn't watch Elf.
That one, and my grandsons wanted to watch Home Alone. By the way, I think we touched on this. How many Home Alones have been made?
32.
It's something like, they said we want to watch Home Alone 5. I was like, there's no Home Alone 5. No. I think there's like Home Alone 6. I was like,
they keep making them until people stop watching them.
Exactly. So quit watching them.
There's only It's a Wonderful Life 1. There was only one of those.
Thank you.
And Mr. Potter, closed down the building and loan. And are we facing a similar fate here in the United States of America with our massive debt? We owe a lot of money. We've got a lot of money that we owe somebody, and we're paying interest on. But to whom do we owe this money, Tom?
Yeah. Oh, the number actually surprised me in terms of the national debt. Now, this is from not our sources. This is from an article, right? So I can't verify the number.
Well,
you want to verify the
article?
number?
The article is from a reputable source.
It is. It says we owe $38 trillion with a T to others. U.S. Treasury securities, which are considered safe because they're backed by the full faith and credit of the U.S. government, which, as you know, can tax people like us to pay those bills.
Right. It can tax you.
It does. But who do we owe? And this surprised me because the nation that I thought we owed the most to is, I think, number 3. But number 1 is Japan, $1.1 trillion. Japan has been the largest holder of U.S. debt for the last 10 years, it says. As of the latest Treasury data, they hold the 1.1. And the reason why is interesting, not only because Treasury investments are safe and have always paid you back, it says it helps Japan manage its own currency, which I did not know. That was a bit of an eye-opener. And institutional investors have invested in U.S. debt in Japan as part of a reserve management and financial diversification. So Japan, $1.1 trillion. And by the way, there's a lot of codependency there, as you may know, between our economy and their economy. Number 2 really surprised me because I didn't realize they had this much debt that they had taken on from the United States. $800 billion owed to the United Kingdom. Wow. That surprised me.
But you know what's interesting? I mean, here we go. 68 trillion. And they
38 trillion.
I thought it was 68. Oh, you said 38.
Let's not double it up. Make it worse
38.
than it is.
Yeah. So really, we're talking less than $1 trillion though at most countries that have our debt, right?
Yes. Well, it was 1.1 at Japan.
1.1 in Japan. Yeah,
United Kingdom, fine. $800 billion. So yeah. And by the way,
we know Japan's not likely to call the note.
That's what I'm saying. We'll get to the one that might be. The UK includes custodial holdings, it says, where they hold U.S. treasuries on behalf of other investors around the world. So it's not necessarily
sovereign
members. Yeah, it's so. But here's the one that has gone down a lot, and frankly is always the one that concerned me, and that's China. China now is $750 billion. I think it used to be number 1, and it says they have modestly reduced its holdings in U.S. debt. As you know, there's a bunch of geopolitical tension between the two of us, trade disputes, you follow the tariffs, et cetera. And so
again, even if they called all that debt, even if they said we want, or they cashed it all in, again, they're going to have to cash it in at market rates.
That's right.
Some of it's longer paper. They're going to get what they get, but it probably wouldn't cause any kind of economic collapse. It would be painful, but it would be reasonable.
And who is the biggest owner of U.S. government securities?
It's not Russia, right?
It's not Russia.
No,
it's you.
U.S.
68 to 75% is held domestically by U.S. entities and institutions.
So we owe us.
We owe us. Like I think, doesn't Vanguard have some bond funds that own some of this stuff, and iShares and people like that? They probably have quite a bit of that hold those bonds that are issued by the U.S. government that are issued basically every day, which is kind of an interesting situation because I always thought other people own more of our debt. And this
right, and we are not going to massively sell all of our debt.
Not run down there in one day and demand payment. No. These are pension funds and mutual funds and state and local governments, et cetera. That seems to me to be the background. The real thing that's important here is, and there was a piece in the Wall Street Journal mid-year 2025 talking about the fact that we now pay as a country more in interest on the debt than we do to finance our military. That's
the part that bothers me the most.
Yeah, that was struggle. Yeah, because we spent $880 billion in 2024 on net interest costs, and by this year we're expected to spend over $1 trillion on interest, which is a lot. So if you take the 128 million households, again in this article, and divide the $1 trillion, we each owe $650 per household per month on interest. I mean, that's not an insignificant amount, right? That's $8,000 a year, whatever it is. So I'm just wondering if I can write that check now and then never have to pay into that again. Is that?
Yeah, I'm pretty sure that's not how it works.
I was hoping for that. Okay. I know it was a
try.
Nice.
I'm sure they'll take your money. I just don't know that they'll make the deal.
I think they'll just take your money and say, that was a pleasure doing business with you. Okay, but when I read all this, do I care as an investor?
Right. That's what it really comes down to. What's the impact on us as investors, and what's the likely impact on our future?
Exactly. So the fact is, because a lot of this does come up in conversations that were owned by China, and you'd have to say Japan now, and then you look at the actual numbers, not so much. We're owned by us. This is money that we all have loaned to the government for various reasons, right? Most of the time because we want to own bonds that have always paid us back, given us the interest and returned our principal. That's most of the reason that people buy this debt. It's always been paid back, as opposed to, well, let's just say Venezuelan bonds, for example, which I think I read before this whole outbreak, they were like worth 10 cents on the dollar. So that's not happened. And which brings me to the second part. I don't think we have the highest rated government debt, do we, in the world?
No, we do not.
Yeah. So, but it is still, I believe, considered among the safest debt in the world.
It's up there because of the size of our economy.
Yeah. I worry a lot about this because I know we're going to get letters about this, because here's the part that does worry me about this. People want to make this political. See, we're spending way too much money, and okay, we could probably make that. See, we're spending too much on interest. Yeah, we could probably agree with you there.
I think that's a reasonable.
Yeah, I do too. But then the question is, what do you do with that information? Mm-hmm. That's when I get worried. Because well, then I'll just go buy what? Fill in the blank. What are you going to own instead of U.S. government debt?
Right. I mean, is it euro-denominated debt?
Right.
Is it British debt? Is it Japanese debt?
Emerging markets?
Russian debt? Emerging markets
that sold
debt?
all the time. Yeah, because guess what? You're making 7%. Sure.
And actually, I found the number on just our mutual funds in the United States. In mutual funds in the United States, there is currently about $3.8 trillion in Treasury securities. So 10% of our debt is owned by U.S. mutual funds. That's us owning it.
Yeah. You're investing in those in your 401k, et cetera, or your IRA.
Here's what's really interesting. Okay, so remember, we're paying that debt service, and it's going to who?
Us.
To whom is it going?
The government. Right.
Well, no, it's going back to us.
Right, comes back. That's right.
It's coming full circle back into our pocket with a fee taken off by the mutual fund company.
Yeah. No. So, I mean, again, if I were looking at this from a high level, which I'm trying to, I would not be I'm overly concerned about how much interest we're paying as a nation.
Yep.
As an investor, I'm not worried. And I would really try, this is something we talk about too with stocks and any other investments. Try to set your politics aside. People make bad decisions.
I know, and that's the problem. That's the problem. Is this one's? I questioned whether or not we should embark on this because of the political arguments, and the argument's going to be, well, that's too simplistic.
Yep.
No, actually, things are pretty simple.
Yeah, but
money is a pretty simple process.
We're going to get the cards and letters on this one, guaranteed.
Yeah.
Guaranteed. that we didn't look at this and we didn't look at that.
But I think the point is, yeah, it's not good. Would it be nice to have less debt? Yeah, sure. But what do you give up to get to that point? What are the things you're willing to not pay for anymore as a government? And that's what we collectively have to decide. And all of us have different opinions as to what that is. Some are going to say it should be social programs. Some are going to say it should be defense.
And you can have those arguments.
You can have those arguments,
yeah.
but the problem is those arguments become...
Well, right now you're either one camp or another. There's nothing in the middle. That's my struggle with all of it. And for those who say we just need to tax more, there's the whole argument of, well, if somebody makes $1 million a year, they should pay way more in taxes. Well, okay, I guess you can make that argument too, because I've never made $1 million a year, so I'm probably okay with it, right?
Although it was really interesting because, again, I am rewatching Mad Men on HBO Max, which, by the way, rewatching it, one of the greatest shows ever made.
I just did this myself.
Written,
You know that, yeah.
Brilliantly
awesome.
Acted, brilliantly directed, and there have been a couple of episodes. There was the one where the account executives were in the corner arguing about whether or not they wanted a raise, and it's good. Well, it's going to put us in the 70% bracket if we get to this point.
70%.
70.
60 years ago, folks.
And then Don Draper is talking to his accountant about selling a house, the house that he owns with his ex-wife, and he goes, and a 49% capital gains tax.
There you go. So, yeah, rates are far lower than they were.
We are way under tax compared to what we were.
But you could make the argument that there was no income tax until like 1920.
Right.
There wasn't.
But
okay.
I'm
not saying right or wrong.
All right. Let's get that right or wrong. But remember, there was no U.S. military basically prior to 1920.
Those World War I survivors might argue with you. But
No. But I mean, we weren't spending much money on it.
No. A couple of tanks, maybe
we were really not spending a lot of money on our military.
We do today. Well, so
we didn't really start doing that until 1941.
Closer to 40. Now, you're right, 40,
the
41.
Big spending was 40. Yeah.
Right.
Really, the big spending happened right about Pearl Harbor time when it really ratcheted up.
Yeah, and of course, 42, 43, 44, 45.
Huge.
Sure, yeah, huge. Massive. Okay,
and then it never let up after that.
No. Let's go to some questions from North Texas, not North Dallas, Texas. Wasn't it North Dallas?
Texas.
That was the football movie. I love
North Texas is that's like half the state.
There's a lot of north there. David writes, "Hi, Don and Tom, regular listener for years now. Thank you for that. I ran across a video about data behind potential market corrections with a 60-40 portfolio." He's speaking of 60% in stocks, 40% in bonds. "I think this part noted below helps to gauge the difference in impact of a market drop versus what happened when I was invested close to 100% in 2001 or 2008. It says, based on your portfolio construction, how much of the overall market correction would your portfolio and would you participate in? So if the market falls 35%, a portfolio that's 60% in that would only drop 21% because the cash bond CD portion is unlikely to fall as the stock portion did." Talks about guardrails. Yeah, we're in full agreement here. And by the way, I think if you go to paulmerriman.com, I think he has all the old tables up there. I think you can look at the big downturns and see what and all. And this is something that human nature suggests you don't have to think about this right now because the market just goes up, 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 right? Well, market has gone up a lot in the last 3 years. So, markets do go up 3 out of 4 years. That suggests that this year, not predicting, it could go down. So this is something people overlook at times like this. So you're right. Having bonds in there has been a cushion. It has provided stability. And we know one thing. You find out who you are when your stock portfolio or your portfolio goes down by 40 to 50%. Now, you don't really know. Then, you learn quickly.
It's really interesting. The biggest decline in a 60-40 portfolio happened in 2008.
Let me guess. Don't tell me.
Yeah.
I'm going to say it was like 33%.
You're dead on.
That's shocking.
Dead on.
Wow.
What was the second worst, though?
Oh, wow.
This one's really interesting. You're not going to get it.
I'll have to say, wasn't the spring of 2020. I'll say 73, 74.
Well, no. Here's a hint for you. Remember, this is a stock and bond portfolio.
So that would be like 93, something like that.
No, 2022.
Wow, that's great. Got you forget bonds
Because
and
bonds
stocks went down. That's right. No
both
cushion.
went down.
Yep, good point. Yeah. So,
And it was about a 17, 16% decline.
I love that. And so when you're doing planning, David, I think we should all be honest with ourselves about the longer-term history of stocks and bond returns, because we've had such nice markets these last 3 years since 2022. And we should all be honest with ourselves about how much this can all go down. I still love your quote, Don, from a few years ago when you said, sure, you can look at your 401k, but then take 20% off it and say, it could be that instead, because these stocks could go down at some,
Right. Whatever you're looking at today, expect it's less than that. Then you won't be disappointed, because at some point it's going to be less than that.
It'll be a lot like your life then. So,
and by the way, what do you think the worst 5-year period has been for a 60-40? Rolling 5 years.
That is really hard. Because that rebounded quick. Again, I'd probably have to go back to 73, 74, something in the mid-70s. I don't know.
Yeah, it was back in the Depression, and it was 8.9.
For a 5-year period?
For a rolling 5-year.
Wow, okay. Yeah. And by the way, we're not picking on the 60-40. 60-40 still works. So I know there'll be a ton of articles any day saying 60-40 no longer works. So
yeah. You know, if it's all, by the way, there is no rolling 10-year where the 60-40 lost money.
There you go.
So if you've got 10 years, you're probably going to be improved. But again, this is what's so important for all of us to remember. What happened before might be indicative of what might happen in the future, but it doesn't tell us a darn thing. The future is totally unpredictable.
No one
it
predicted
always
COVID.
Will be.
No one predicted the rapid, interest rate change in 2022 that led to those markets. No, I think that's really well put. Okay,
right,
from Waxhaw, North Carolina. Is that how you pronounce it? Waxhaw. Waxhaw, North Carolina. Rich.
I'm deferring to you.
Writes us and says, hello, everyone talks about how bad or good bonds do in a given year. And by the way, an intermediate term bond fund had a good year in 2025. Isn't the point of a bond ETF like BND, which is the Vanguard Total Bond, to give monthly income? If monthly income is the goal, what's the point of tracking good versus bad years?
No, that's not the point. You see, that's the mistake. That's what everybody. That's what gets people investing in dividend funds. Well, it's all about the income. No. We don't believe that. We believe your income is derived from your entire portfolio. It is a holistic income stream. Yes, part of it will come from your bonds. They will pay some of that income stream, but they're there primarily for the purpose of dampening volatility. They are a shock absorber.
Yeah. And so, yes, you're going to get some interest income from those bonds, but that's not why you buy them.
It's the interest that adds stability, because that interest is a buffer. Let's say your stock portfolio is down 10% and your bond portfolio is flat, but it paid you 2%.
Guess what?
Well, now your net loss is only 8%. It's dampened by that.
I agree. From Rock Rapids, Iowa, Pete writes us, Don and Tom, I love the podcast. This is just a comment, by the way. Where are you on spam, by the way? Don?
Hormel or...
you broke the code. Dang it. Talking about Hormel brought back memories. In the 1980s, I was in high school. My dad owned a small manufacturing company, and he produced the small key that opened the spam cans.
Oh, the spam key. I love with a little hole in it, and you stick it on the tab, and you cut your finger on that little tab hanging off all the time.
Yeah. When the Hormel strike in Austin, Minnesota happened, Hormel switched all their production to Nebraska, and my dad's account provided all the cans for that plant. Wow, that must have been a windfall. At peak production, he was making 2 million keys a week. It was a windfall.
A week. Wow.
We heard that the U.S. military and Hawaii were the biggest consumers of spam at the time. Hormel later went to a pull tab to open the can, so my dad's business went the way of Motorola. Keep up the great work. Just comment. This goes back to us discussing Hormel stocks.
Technology's changing.
Yes, it does.
All the time.
Roll those spam
and again,
open,
going
man.
back to Mad Men, when Don's sitting there with a church key opening a can of beer.
That's right. I remember that. Yeah, snap. Yep.
I'm going, I remember,
That must have been an off day for him because normally it was something a lot stronger, is my recollection from the show, than
He's
beer.
telling his secretary, stop me at 3.
Yeah, and lock the door and make sure nobody comes in here because I'll be resting. DK from
How did
Glendora.
people survive in the 60s if they drank
watching that it
and
just made me
smoked that
physically ill.
much?
I know. Well, they're not alive today. DK writes us from Glendora, California. Hi, Don and Tom. Thanks for everything you do to educate people. Listen to every podcast you release. Thank you, DK. I have a quick question. You recommend AVGE, that's the Avantis Global Equity Fund, and DFAW, that's the Dimensional Global Equity Fund, for the equity portion on your calls. For Apella clients, does Apella use these ETF or equivalents that are invested for the equity portion?
Yeah, kind of.
Well, we don't use those funds particularly.
Well,
No.
but we use the same sort of take, except
Exactly.
we use more funds to do it.
Thank
Using
you.
those is the simple solution for listeners to the radio show.
Yeah.
If you want to complicate it more, we could give
It's
you those,
harder.
but we hate to do that because we know it's not going to end well for you because you won't do the things you need to do along
Thank
the
you.
way.
So, for example, I believe that we have been selling some parts of the portfolio for, I think, International Small Cap Value, which was up like 47% last
To
year.
rebalance.
Correct. You wouldn't have to do that in AVGE because that's done for you. Now, you might miss out on part of the return. There's a whole bunch of factors that suggest that managing it with more funds that way, kind of emphasizing parts, decrease, et cetera, have added return. Don't know about the future. And frankly, we don't know if AVGE will just outdo a regular boring index portfolio in the future. We couldn't tell you that. But looking back, being more in those particular types of assets has added a bit of return. So, but those are fine. And I think for many do-it-yourselfers, sure, why not one of those and a bond fund and go home?
Again, it's what we're talking about is differences, potential differences of fractions of a percent, not even percentage points, by getting more granular. So you, as an individual in your accumulation phase of life, when you don't have millions, go ahead with the simple stuff. It makes your life easier, and that's kind of important in the grand scheme of things.
Exactly. Simplicity, sure. Low cost, absolutely. In fact, I'm reading a book on investing for teenagers with my daughter, and they even say, be diversified. I loved it, but the rest of the book, not loving it because talk about dollar cost averaging and alternative investments and stuff that teenagers, unless you're going to end up running a hedge fund, you don't need to know. She's like, when do I need to know that? Never.
Right.
Never. That's nothing to.
I'm thinking about writing a pamphlet
Yeah.
on investing for teenagers.
be
It
like-
only has to be 4 pages long.
I was going to say, I thought you were going to do the 250-page book with 125 blank pages in it. I kind of like
No, a
that.
250-page book with 200 blank pages.
And you could, that
That would be the
most people,
appropriate
that would
book.
be enough. And for teenagers,
Book.
for sure. Get started, put something in the market. That's all
Do you know how
need
many
to know.
podcasts this guy's listened to if he listened to them all? Over 1,800.
Yeah,
Over
1812.
1,800. Over 18.
And
We're going to
thank you,
hit
by the way, for all
2,000
you-
this year.
That's crazy. Thank you all for who've listened. By the way, what's our total number of downloads now?
For the year?
No, forever.
For all time?
All
Do I even
time.
have that? I don't have that
know.
number.
I'd love
I
that.
seriously don't. You know why I don't have that number? Because I've changed podcast hosts.
Well, you need to find that number.
No, I
We need
can't
to know.
find that number.
I need to put it like the McDonald's, 10 million hamburgers and counting or whatever it
there's
is.
no
We need
way
that number. You'll find it. I
No,
know
that
you.
doesn't exist.
It's out there.
No, it's not. Trust me, it's not out there.
I'll tell you what is out there. You know what's out there?
I mean, okay, about 2 million a year now, so
For the last couple of
let's
years, and
say
you throw in a few more
10,
million all those other years.
15 million
Yeah,
downloads.
something like that. So 15 million served.
I don't know.
Keep it coming. We
Oh,
appreciate listening.
on a previous podcast a few days back, we talked about Retire Meet, which is coming up on March 7th, and we were trying to figure out when the first one was.
Did you figure it out?
Figure it out.
What year was it? I said 2014.
2015.
Oh, I was close.
February 7th, 2015.
So this is number 12
This
then?
is
No, because if you count 15 and then
to 25, so it's 11.
a lot of podcasts too, and a lot of so Retire Meet. You can sign up now for the virtual session at Retire Meet, and if you're in the Seattle area, want to come. Somebody just wrote me and said they're flying into Seattle in March to see us in person. Love to see you. So either way,
See, look at what Retire Meet is doing for Puget Sound tourism.
Exactly.
Because nobody comes to Seattle in the winter.
Not till maybe late June if you're smart. So, and you pray for the weather then. So join us. Christine Benz, Paul Merriman, Don McDonald, Joe Saul Seahigh from Stagnant, et cetera, talking about all things retirement, Medicare, Social Security, planning. We do it all in a day. Was that faster than Scrooge did it in? Anyway, we do it all in a day.
No, he did it in just like one night.
That's right. We get it all done, and you have a better future. So join us. You'll love it.
And then you can go downtown and enjoy the Mad Men era World's Fair pieces of stuff that exists still. Wasn't that the first monorail?
I believe it was 1960.
I don't.
62
Or did Disney?
Fair?
No, I think Disney had a monorail before that. Disney
I think
had the
you're
monorail
right. Yeah.
Before that,
Okay.
so,
Well,
yeah.
we're happy to be number 2 to Disney. I'm okay with that. So it's good. But sign up for
1962
retirement. We'd love to
World's
see
Fair
you.
was in Seattle.
62. Was I right?
Yeah, 62.
Okay. All right. I think John Kennedy was supposed to come and then didn't because of the Cuban Missile Crisis.
Definitely Mad Men era stuff.
Yeah, absolutely. And you are stuck in Mad Men thing right now, so that's fine.
I got 3 more seasons to go.
I loved the whole thing. I rewatched it too and thought it was wonderful. So, speaking of wonderful, thank you for a wonderful podcast.
Yes, it was a wonderful podcast, and it's been a wonderful life. And Mr. Potter is not going to foreclose on the country. And if you have questions for us, you can go to talkingrealmoney.com and hit the contact form and send them in. And other than that, we're just going to go back to whatever it is we do every day, which probably has something to do with, I don't know, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Apella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.